Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Ryan Detrick, Chief Market Strategist over at the Carson Group, to discuss just how much negativity is in this market. And it could be a good year for the economy in 2023. Ryan, it is great to see you as always. Welcome back to Trade Talks.
Jill, thank you so much for having me back. I'm excited.
Yeah, me too. And what are you expecting from stocks in 2023? Because there is a lot of negative sentiment out there.
Yeah, I mean, I'll tell you what, you're right. I mean, just about every shop that comes out is talking about potentially going back to the new lows and making new lows for stocks. You know, I guess we'll put it like this. When we look at the world here, we're going to have a negative midterm year, right? The following year, pre-election years, never been lower, Jill. Higher 8 out of 8 times, up like 25% on average. So it's just one way to look at it. I'm fully aware. When you factor in the fact, kind of funny to say, when you look at the fact that you have inflation likely coming back down, you've got, the economy that's not going into recession, an economy that's still strong, led by a consumer. All these things with the U.S. dollar going lower, which could add some to earnings next year. I guess to put a bow on top here, we think next year could be a surprisingly good year for stocks, even though virtually no one is talking about that.
Yeah, I mean, if you get just one of the factors that the market's facing, whether it's inflation, Fed policy, the war in Ukraine, you just have one of those get alleviated, and it could be off to the races from there. And it doesn't necessarily have to be a year like we saw in 2020 and 2021, where the gains were just an anomaly. There's nothing wrong with the 8, 10, maybe 15% gain, which is a little bit more normal.
Yeah, I think we'd probably take that after what we've seen this year. But, the first question you asked me about sentiment, right? And yes, you look at a Bloomberg recent survey, like Wall Street Strategist, this is the first time in multiple decades they're looking for stocks to go down this year. If you look at put-to-call ratios, we've seen, I should say down for the next year. Put-to-call ratios have been extremely high. Options markets worried. The VIX has been up there. I mean, there's historic levels of fear. Right. And after this bear market and with bonds haven't done very well, we get that. But again, so much is priced. I believe the old adage is, it's hard to get hurt falling out of the basement window. Right. That's an old Wall Street adage. There's a lot of bad news priced in. If we get any good news, and we think we can, that could be the spark for a pretty solid year next year.
Right. And to your point, if you think a recession will be avoided, the consumer is still quite strong. Yes, housing, yes, manufacturing, not quite as strong as the consumer, but we really do need them to hang in there and continue with the spend trends that we've seen.
That's right. I mean, what have we heard over the past couple of weeks, right? Record credit card debt, year-over-year credit cards up 15%. That's all true. You can't argue with that. But that's, the debt. Look at equity. People are worth a lot more. If you look at credit card utilization here, Jill, about 21% of what someone could spend on their credit cards, what they're using. What in the world does that mean? It was 25% before the pandemic started. So everyone said, oh, people are maxing out their credit cards. They're not, right? The consumer is spending, but they're 70% of the economy. To us, that's keeping it going, kind of like 94. Remember 94? The Fed hiked rates a lot. Bonds didn't do well. Stocks didn't do well. Economy was kind of wishy-washy. And then it expanded in the mid to late 90s. We think this is kind of like a mid-cycle slowdown. Not exactly like 94, but there are some similarities.
Well, it's interesting because I've had a number of strategists come on the show saying that the 60-40 model portfolio is not dead. If you go with the theory that fixed income's recovering, equities will recover in 2023.
Yeah, we wouldn't disagree with that. I mean, what's the biggest thing bonds hate? Well, inflation. We just had 40-year highs in inflation. That's why bonds have had a terrible year. But you think about it, right? The yields are probably going to start to come lower. Inflation expectations start to come lower. We think bonds are down 2 years in a row. That's never happened in history. Probably not going to be down 3 years in a row. But for 2023, we still like stocks. We just upgraded actually our view on stocks here for our advisors at the Carson Group. And we think stocks will do better over the next 12 months. But bonds, they might have a decent year as well.
Yeah. Any sectors in particular that are more attractive than others?
Yeah, we like cyclical value. Look what's leading all of a sudden. Industrials, financials, energy still done well, but some of those are good. And healthcare is not quite a cyclical value. I get it. But those are some of the areas we like: cyclical value, small cap, and healthcare.
All right, Ryan, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.